Hey guys, in this video we're going over some rules you need to follow so you don't blow up your account when you're counter trend trading. That means that when you're trying to predict reversals, trade bottoms, trade tops, you need to make sure that you implement some rules or else your account can blow up really fast. I've seen this with a lot of our traders who are trying to counter trend very often, and they're seeing the trades go against them and seeing massive losses because of it. And I don't want you to be one of those people. Now again, do losses happen? Absolutely. There is no perfect system, but there is one that I want to share with you today. So if you don't really know how to counter trend or strategies for that, go check out my video from yesterday where I walked through how to counter trend and predict reversals, bottom and top, and how to trade it. Now we're going to talk about the rules in this video. So the rules come from this 10% credit spreads trading handbook and guide and handbook, and if you want this, you can click down below in the description to get it for free. It's completely free. It has all my strategies step by step, credit collection, trade sizing, early exit rules, and what we're talking about today is counter trend trading rules. So let's jump to that section here. Okay, so counter trend trading rules. Let's kind of zoom into this here a bit. Okay, let's just zoom in. All right, if you are trading a counter trend strategy like the elastic rejection or bounce strategy, which we talked about yesterday, which means that if you're trying to predict the top and trade it on the way down, or predict the bottom and trade the bounce up, again, you need to follow these rules. So again, this is what's going on. The first rule, only enter a trade on a strong green day for electric or a strong red day for a bounce strategy. So this is when we kind of went into the strategy rules, but for instance, when you're trading the downside looking for a bounce up, you want to make sure that it's been previously going down very hard, so like this, where it's going down very strong, very fast. And when on the downside, you want to look for a doji candle, which is indicative of reversals. Right here, we came down, doji, which is long wicks in the small body on a candle. Long wicks, small body right here, if you can tell. And so again, we see this reversal, see this reversal once we have a huge long rundown. You can see that here as well, and this doji candle looks a bit different. So you can see here, we have a huge rundown, doji candle here, long wicks, and then you can see here another doji candle and another doji candle. So all in the same range. They don't always predict the exact spot it's going to reverse, but when you see a strong move downward followed by a doji candle, that's a strong sign it's going to bounce back up. Whoops. We've already messed it up so far. Sorry, ignore that. Okay, so that's what we're looking at for the downside. For the upside, as I mentioned in the video yesterday, we're looking for a strong push up to the upside. We want to see a strong green candle pushed through this upper bound range, and then we want to see kind of a move start down. But you can also enter on this strong green move. We're just looking for a strong green move. Why? Because that's going to elevate call prices, which is going to allow us to get into a call credit spread way further out of the money and still collect a decent premium, and therefore provide us more safety. So strong green on the upside, down fast move with doji candle on the bottom. Next, the second rule is to size down and only trade 50% of your typical position size. Why? I am a trend trader. I've been trading the trend for 6 years now, and I know how well it works. Why? Because not only does it work for myself, it's worked for hundreds of other students, and it's been working for decades, and not even that, almost 2 centuries. There is mathematical evidence and historical evidence to show traders that have been trading the trends for over 2 centuries now, and it working. And because of that, I think you should never ever fight the trend. So when you are doing a counter trend trade where you're trying to make some money on the opposite play of where it's going, for instance, this is trending up, but we want to make money on a quick downside move, you want to make sure you put less of your account size into it because it is a riskier play. You are betting it against the market. It's like you're going surfing and you see this huge 50-foot wave coming towards you, and instead of turning your board around and going with the wave, you're like, I think I can go straight into it. That's what counter trend trading is, so you have to be very, very careful. So only use 50% of your max position. So you typically use, let's say, 10% of your account into any one trade. Now only put 5% of your account. Or if you typically put 5% of your account, now put 2.5%. Just so that if you do lose, it's more manageable. All right, next. The third rule is to immediately close out any open counter trend positions if one of your counter trend trades expires in the money. This is specifically applies to my specific rules. If you're following my trading rules, which are listed here, and you're a part of the 10% credit spreads community and Trade Ideas Algo membership, again, this is for you, and I'll explain it here. Why does this work? Well, because let's say we have trades, right? Because we put on trades every single week, if not every other day. And so, for instance, let's say a call credit spread trade we put here. Then another one for the next week we put here. So these are talking about different weeks and expiration. Okay, let's say this week's expiration gets hit. If this week's expiration on our call credit spread gets hit, which means it's now losing from a strike price basis, this means that there's a 75% chance that the next trade will also lose. Why? It means that the trend is still going in its favor, momentum is picking up, and it's not slowing down as much as we thought. Because there's a 75% chance that if this trade fails, then this trade fails, then what we need to do is, if this trade fails, our first one expiring the closest amount of time, if it expires in the money, so we experience the max loss, then, and you have another trade out for that next week that's coming in, then you want to close it out early. Why? Well, because there's a 75% chance it won't make money. So we might as well close that trade out now so that we don't have another max loss. And instead, we only experience about 25 to 50% max loss, depending on how much that stock has moved, right? So again, this is one of the rules, is to close out if your prior trade expired in the money. Why? Because the trend is picking up, and it's not something we want to do. So all these counter trend trading rules are listed right here in this document for free. Yes, I give it for free, nothing required except an email address, so I know where to send it. Link down below. Anyways, guys, if you're trying to get better at credit spreads trading or want more strategies, whatever, I am your guy, as I post videos every single day to help you master strategies and trade credit spreads to make reliable monthly income. So if that's for you, click the subscribe button and the notification bell, and I will see you in the next video.